name is Marilena and I will be your hostess for today. Together with me I have Peter, our senior market analyst at IronFX. Hello Peter.
Hello.
Thank you for joining us today as we're looking at the fundamentals on driving the markets currently. So Peter, how have the markets behaved since yesterday?
So there is a relative inactivity, I may say, and that was, especially for the US dollar, very characteristic. It seems that the August holidays have started to affect the markets, and slowly but steadily volatility is slowing down, which may or may not more or less reduce the interest of traders.
And what could be the effect for the US stock markets?
Well, it was more or less the same. US stock markets maintained a rather stable movement. It was characteristic, especially of the Dow Jones, how very low volatility was across the board. Even recent earnings reports have started to produce reduced interest among traders. We should also note that most high-profile companies have already released their earnings reports, so it's understandable that we had this slowing of interest. On the other hand, though, we had headlines today which were quite interesting. There was a release which showed that Elon Musk has sold around 7.8 million shares of Tesla. Now, the total proceeds were of around 8.8 billion US dollars. It was a big amount. And it seems that the sale was made around the 5th to the 9th of August, according to SEC filings, and may be related with Twitter. And how is that? Should Twitter be able to legally enforce the buyout, which was practically promised by Elon Musk, then Elon Musk may have to find additional funds. And in order to be prepared for such a scenario, Elon Musk opted to sell shares of Tesla, get the necessary funds, have it in cash, and practically funded the deal. Now, the news as such create a certain inconsistency, because Elon Musk at the end of April had mentioned that there would be no more sales of Tesla shares by him. And he did quite the contrary. And that's a little bit worrying. On the other hand, though, that could also enforce, or if you prefer, reaffirm the possibility that Tesla will be forced to actually proceed with the buyout. And that could provide a boost to Twitter's share price. Twitter's share price also got a boost on Friday the 5th. So it's a bit of an issue.
And what's on the calendar for today?
Well, it's definitely CPI day today.
Okay.
We have the US CPI rates for July, and the CPI rates are expected, the headline CPI rates are expected to slow down both on a month-on-month as well as on a year-on-year level, which may imply that inflationary pressures within the US economy have slowed down, actually have peaked, and may be rolling back down now, which could ease the tensions, or if you prefer, the pressure on the Fed to actually continue hiking rates at an aggressive manner. Now, should the forecasts be realized, or should the inflation rates actually roll down even lower than what's being expected, we may see increased volatility, and that could more or less weaken the US dollar, as the expectations for the Fed are going to be reduced. On the flip side, given that US stock markets have been worried about the possibility of the US economy entering a recession, that could provide a slight boost. Other than that, I would be noting also from the Czech Republic the CPI rates. And should they accelerate, we may see the Czech krona getting some support here. Oil traders, on the other hand, may be more interested in the EIA crude oil inventories figure. It's on a weekly basis, and it's expected to drop from the surplus it showed last week to a very slight drawdown. Now, such a result could imply practically that the US oil market becomes somewhat tighter, as demand levels may have surpassed production levels. Once again, though, I would be highlighting the possibility of an upside potential surprise. Especially, I would be highlighting also the Cushing oil reserves. That should be it, yeah.
Moving to the energy, how have oil prices been behaving?
Well, we definitely would like to see how oil prices will be behaving, practically more related to the EIA crude oil inventories figure. And overall, though, there is a slightly bearish sentiment for oil market and for oil prices as such. It's going to be a battle between the two, and that could change also depending on the outcome of the EIA crude oil inventories release.
And now to precious metals, is gold price relatively stable?
Yes and no. It's on the one hand relatively stable, on the other hand there are slight movements here and there. And I would be highlighting today the negative correlation of gold's price to the price of the US dollar. And should we see a US dollar weakening due to the release of the CPI rates for July, we may see gold's price ascending. And that would be an interesting development for the precious metal.
Any final comments, Peter?
Well, I would be a little bit worried also on the monetary front, because we have Chicago Fed President Evans, which will be speaking, I think it's after the release of the US CPI rates. Now, should the Chicago Fed President proceed with some hawkish comments, which would practically reaffirm the Fed's hawkish approach towards its monetary policy, that could provide some support for the USD. Other than that, I would be highlighting also BOE's chief economist, Hugh Pill, which could be making some comments which could be of interest for pound traders. That should be about it.
Great. Thank you, Peter, for your time, and everyone for watching. Join us after a short break for technical analysis with Peter Yosef.
So, welcome to the technical analysis part of the presentation for today. In front of your screens, you have, as you can see, the US dollar index. It's the 4-hour chart, and overall, we tend to show 4-hour charts. So, unless otherwise stated, please note that that's the default time frame we use in our charts right now. We note that the US dollar index has been quite stable, very tight range bound movement, just above the 105.90. Now, we had some comments about the possible correcting of the S1, which I found quite valid, and I would like to note them. Now, viewers had suggested that practically the S1 could be lowered to the 105.50. It's a suggestion that we adopt, given that we had touches here and here, which were very interesting. However, the other levels seem to remain unchanged, so we keep them. Overall, the direction seems to remain unchanged. It's a sideways movement bias which continues to dominate. I would note, though, that the price action seems about to be on a collision course with the upward trend line, which was incepted let's have a look at the daily chart. Here it is. Since the 9th of February, 10th maybe, yep. Drilling back down to the 4-hour chart. And should overall the price action remain stable, we may see it testing, if not even breaking, the upward trend line pre-mentioned, and that would be verifying practically the sideways movement as long as the price action remains between the 105.50 and the 107.20 levels. On the other hand, should the bulls take over and should the price action practically bounce on the upward trend line pre-mentioned, we may see it actually would require the price action to break above the 107.20, practically breaking the upper boundary of its current sideways movement. That would be a first sign of a trend reversal to the upside, and the bulls may lead it upwards, starting to aim for the 109.10 resistance level, which is also the highest level in our chart. You can see it right here. And was produced practically on the 14th of July. To the downside. Now for a bearish outlook, we would require two elements. Actually three elements. A, the price action to break the pre-mentioned upward trend line. First, trend reversal signal. Second, to break clearly the 105.50 support line, not something like this. I would require to clearly break it and start aiming, that would be a third element, for the 103.45 support level, maybe even touching it. That would be an indication for a bearish outlook of the USD index. The RSI indicator has broken just below the reading of 50, yet remains pretty close to it, so that would imply more an indecisive market rather than a bearish outlook. So that tends to support the notion of a sideways movement, as per mentioned, between the 105.50 and the 107.20. Note also how the the Bollinger Bands have started to converge. That's another indication or result, if you prefer, of the low volatility present currently for the USD index. Okay, let's have a look at Euro USD. Sorry, 1 second. Now, Euro USD has also been moving in a sideways motion, interestingly enough, and that would also imply the lack of fundamentals on behalf of the common currency. On the other hand, would imply also that's USD driven. Now, should that be the case, and should at the same time the release of the CPI rates actually disappoint traders, in case, say, for example, the US CPI rates slow down even more than what the market expects, that could weaken the US dollar. And should Euro USD actually be USD driven, that could imply some bullish tendencies for Euro USD. In such a case, we may see the price action breaking above the 1.0275 and start actively aiming for the 1.0380. On the other hand, should the bears take over, say for example, if the US CPI rates, instead of slowing down, accelerate further and considerably, that could strengthen the US dollar and could weigh on the Euro USD, driving price action lower, breaking the 1.0110 and starting to aim for parallel level. Yet, there is an example which we could refer to, and that would be the release practically of the US employment report last Friday. We had very strong figures which provided support for the US dollar. Yet, let's have a look at the release. What was here? Yet you note that the movement which was made, albeit characteristic, may not have been as wide, or if you prefer, the drop may not have been as wide of Euro USD as was anticipated, and the pair maintained a clear sideways movement despite the strengthening of the US dollar. That's something which could be repeated also today, and it would be highlighting that for Euro USD to start dropping, I would dare to say a more consistent bearish sentiment for the pair would be required. In any case, should the bears take over, as we have mentioned, we would expect the price action to drop, break the 1.0110, and start aiming for parity level at 1, PS2. As long as the price action remains between the 1.0275 resistance line and the 1.0110 support line, we tend to maintain a bias for sideways movement between the prevention levels. Once again, the Bollinger Bands seem to be converging somewhat, but that's nothing definite yet. On the other hand, excuse me, the 200 and the 100 moving averages seem to be running in parallel, also implying some inactivity, given that the 100 moving average fails to converge towards the 200 moving average or diverge, depending on the movement. On the other hand, I would also note there is an indicator below the forward chart. Okay, it bounced on the reading of 50, rising just a bit. It's actually currently at 55. But 55 is nothing conclusive yet. You can see how the RSI indicator has been practically rotating around the 50 level, yet the price action remained rather stable between the 1.0275 and the 1.0110. I would be keeping the sideways motion bias. On the other hand, if we drill down out to the daily chart, we can see that there is a wide downward trend line which has been guiding the pair, and that was since the 10th of February. We had consecutive lower peaks and lower truths. This one being an exception, but still. And we see a stabilization. So at some point in the next couple of days, probably up until Friday, maybe even Monday, we may see the two colliding, and that's going to be an interesting point for Euro USD's direction. Is it going to be following the bearish trend line and move decisively lower, or is it going to maintain its sideways motion or even rise and break the pre-mentioned downward trend line? For the time being, once again, the sideways motion bias seems to be prevailing. Let's have a look now at GBP USD, and we note that the movement differs. It's once again the 4-hour chart. However, despite the differing movement of the chart, we note that there is stabilization here. And in this case, the downward movement seems to have been interrupted. No matter how I move the trend line, we lose on touches, especially here in the mid-level. And we note that this downward trend line seems to have been broken, this time clearly. So a stabilization seems to have been occurred. We tend to maintain our bias for a sideways motion, or if you prefer, we switch our bearish outlook in favor of the sideways motion. For the time being, just above the 1.2070. Grateful for your comments yesterday about cable. There was a suggestion which was quite interesting, and or if you prefer, the suggestion was that there may be a mid-level of a resistance at the 1.2130. That's something which, let's have a look, is here. Basically, it refers to these levels here, and the support touches here and here. It's a possibility which, once again, we're not ruling out. For the time being, though, we have multiple touches to the downside and to the upside. For the 1.2070, we tend to maintain this as a support line, while on the flip side, the 1.2180 has proven its worth a couple of times. So we tend to keep that as a resistance line. But yes, I would also be keeping an eye out for the 1.2130 as a mid-level, which could be influencing the pair sideways movement, given also the tight range-bound movement of the pair for the past 48 hours. Other than that, for a bullish outlook, we would require clear breaking of the 1.2185, and for the pair to start aiming for the 1.2330, which for the time being seems to be too high and very difficult to achieve, given the low volatility. On the other hand, though, should there be a substantial disappointment of traders regarding the US CPI rates, we may see the price action of cable actually breaking the 1.2185, despite seemingly being very wide, too high. Once again, I would like to note that the release of the US employment report on Friday, which was this large red candlestick here, created movement of around 130, 125 pips. It's a distance which practically would cover the distance up until the 1.2185 resistance line and actually break just above it. So it's possible. On the other hand, should the news of the US CPI rates actually excite USD traders, we may see the drop of the pair of cable definitely being beyond the 1.2070 support line, maybe even start touching the 1.1935 support level. And I would highlight the possibility of an outsized market reaction, an outsized upward reaction of the US dollar in case the US CPI rates, instead of slowing down as the market expects, accelerate. Actually, I would expect the reaction on the USD in case the US CPI rates accelerate to be asymmetrical to the market reaction in case the US CPI rates slow down as expected or even just a little bit lower. So that's another big issue which should be highlighted. It's anyways the main event of the day today. To the downside, we have mentioned the possibilities for the 1.2070 as one to be broken clearly, and the price action to reach, if not breach, the 1.1935. On the other hand, the sideways motion seems to be prevailing, yet it's dependent on the US CPI release today in the early American session. Once again, that should be for cable. Oh, yes, we should also mention that the RSI indicator seems to remain near the reading of 50. Actually, it's at 48.2 and seems to be implying a rather indecisive market right now. It's characteristic how the RSI indicator remained pretty close over the past 24 hours to the reading of 50. Let's have a look now at safe havens, and we make a start with USD and JPY. Give a sec. USD JPY also in a sideways motion. Nothing of surprise here. And interestingly enough, you remember yesterday, as we had mentioned, the possibility of a bullish movement due to the upward trend line. Now that same upward trend line has been broken, and it forces us to practically switch our bullish outlook in favor of a sideways bias. In this case, just above the 134.70. It's a very tight range-bound movement, yet we would expect practically the pair to show increased volatility once the US CPI rates for July are to be released. Should the bears take over, in case the USD weakens, we may see the price action actually breaking the 134.70, which is close by, just below it, and start aiming for 132.75. On the other hand, should the US dollar strengthen, we may see the price action rising, aiming, if not testing, the 136.75, maybe even breaking it. But for the time being, the sideways motion seems to be prevailing. In this case, we may be seeing practically another mid-level, which should be mentioned. It's here. It's the 135.55. It's a very interesting level because at that point we have touches to the upside and to the downside, and some touches here and here. So keep an eye out for it, as it was practically verified in the past 48 hours. Yeah. And we may see it coming into effect, actually being into effect. Okay. Let's have a look now at the other safe haven, and that would be USD CHF. USD CHF, which tends to maintain a clear downward motion. You can see it here. Nice downward trend line being formed, guiding the pair, even with some corrections, which are quite interesting, given that it provides the chance to the pair's price action to create lower peaks and lower troughs. So we would maintain a bias for a bearish outlook here. Let's make the necessary adjustment on the chart though to have a clearer view. On the other hand, one could argue that there is a sideways movement between the 0.9640 and the 0.9455. For the time being though, given the downward trend line exists, I would prefer a bearish outlook as long as it remains active, and I wouldn't be surprised to see the price action breaking the 0.9455 and start aiming for 0.9375. On the flip side, should a stabilization take place, which is also a possibility, we may see the price action breaking the downward trend line, stabilizing though between the 0.9550 and the 0.9455. For a bullish outlook, we would require a clear breaking of the prementioned downward trend line. That would be a first signal for a trend reversal. And then we may see the price action breaking clearly also the 0.9550 resistance level and start aiming for 0.9640 resistance barrier. Note how it provided resistance here. It was tested, resistance. Quite interesting. Okay, let's have a look now at commodity currencies, and we'll make a start with the USD CAD. USD CAD, which has been in sideways motion, low volatility, once again being present. We tend to maintain our bias for sideways motion between the 1.2945 and the 1.2780. Note how the pair rose, that was on Friday, reflecting practically at the same time the strengthening of the US dollar and the solid rates and figures reported by the US employment report for July. At the same time, we have to note that there were conflicting fundamentals given that the Canadian employment data were actually adverse for the Canadian dollar, given that the employment change figure remained in the negatives. But still, the market reaction may have not been as wide as we may have been expecting. So we tend to maintain our bias for a sideways movement to be preserved between the 1.2945 and the 1.2780. Should the USD weaken, we wouldn't be surprised to see it aiming, the pair USD CAD, aiming for the 1.2780 support line. In a possible outsized weakening of the US dollar, we may see the pair even breaking the 1.2780 support line and start aiming for the 1.2685 support level. However, that would be practically implying a switch from the current sideways bias into a bearish outlook. While on the flip side, should the US dollar strengthen, we may see the price action rising, breaking the 1.2945 and start aiming for the 1.3075 resistance level, which would be implying practically a bullish outlook, as it would be breaking the upper boundary of the current sideways movement. The RSI indicator remains near the reading of 50. It's actually just below it right now, ticking, right here. And that would be implying rather indecisive market, also supporting the notion of a sideways movement here. Let's have a look at the second commodity currency, that would be AUD/USD. Oh, that's nice. AUD/USD yesterday was testing the 0.6975 support line, broke below it, and seems to be finding some resistance once again. There is a commotion here, which is quite interesting. And I would be readjusting practically the levels. I would like to catch this point here. It's a very tight range bound movement. Let's make some modifications here. And here, this could go lower, somewhere here, and this could go even lower, somewhere here. That would be an alternate view. And this could go even a little bit lower, somewhere here. Yeah, that's also a possible view. Correct. It's a pretty tight range bound movement though. Okay, let's keep it and have a look. Let's make the necessary adjustments. Correcting the labels, 71.35. The R2 is being placed now at 0.7 74.45. There you go. Working this in. The first resistance line now is being placed practically at this peak here, and that would be the 0.6995. Let's have a look if there are further levels to rise. Around 70. Nope, that's too high. That's it. He's aiming here. So we have a 0.6995 as the first resistance line. First support line being placed at 0.6945. Second support line being placed at 0.6880. And the final support line being placed at 0.68. There we go. Let's lock this in. Everything in place. And we have changed practically, we have readjusted the levels to encompass practically the movement of the past 24 hours. The sideways movement here. Now, a possible drop could push the lower boundary a little bit lower, but for the time being, given this verification here, it holds. To the upside, note how the 0.6995 was tested. Actually aimed for. Missed by just a few peeps. Higher than that, we have the 0.7045 resting practically on this peak, and even higher the 0.7135. Let's have a look where that stands. There's 3 actually out on this pick here. Okay. It seems to be a total void. Okay, we keep that. Readjusting once again. Support lines. We check the validity of 0.6945. The 0.6880 practically rests here, 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 here. Was tested here. Seems to be quite valid. And the 0.68 was tested here and here. So that would be also quite valid. Okay. For the time being, we tend to maintain a bias for sideways motion between the 0.6995 and the 0.6945. May I remind you, those are boundaries being set by the price action itself in the past 36 to 48 hours. It seems to be quite valid for now. Yet, the release of the US CPI rates for July could increase volatility substantially for the pair and change its direction. Now, for a bullish outlook, we would require clear breaking of the 0.6995 resistance line and the pair to start aiming for the 0.7045. That would also allow us to shift the trend line to this. For the time being, though, that remains to be seen. In the case of a bearish outlook, for a bearish outlook, I would require clear breaking of the 0.6945, which was tested here yesterday. And for the price action, as we have mentioned, to break clearly this one, to to start aiming, if not even testing, the 0.6880, which was tested here. The RSI indicator dropped below the reading of 50, yet corrected a little bit higher. It's still surrounding practically the reading of 50. Didn't place in considerable distance. So that could imply practically also rather indecisive market. Once again, the release of the US CPI rate could create some volatility for the pair, increased volatility for the pair. Let's have a look now at the Kiwi, which has broken above the 0.6290, yet seems to be in a sideways motion. Okay, we could alter that. We're going to be adopting this as a primary support line. Sorry, resistance line. Okay, and abandoning this one. Let's move a little bit backwards to see if there is any. Oh yeah. Yeah. Nice touch here. And that would be the 0.6425. The final resistance level, yeah, that remains valid. It's being placed at 0.65. Okay. Let's readjust. And the R1. I think the new levels describe better the sideways motion of the pair and its boundaries. So we would maintain the bias for a sideways movement between the 0.6350 and the 0.62. Pretty wide, but it could be covered within 24 hours. We're talking about 150 pips. It's doable. It's a little bit extreme, but yeah. Now let's have also a look at gold's price. It was a rather inactive one. Okay. There's still an upward motion. It's nice how it bounced practically on the upward trend line we have mentioned. So our bullish outlook remains valid for now in today's European session. That could have also been a result of the weakening of the USD, the slight weakening of the USD. In any case, though, I would like to see a clearer break above the 1793 resistance line. Let's make the readjustments here so it's more visible. For the time being, we tend to maintain a bullish outlook, and I would expect definitely the next peak to be higher than this one. Probably aiming for the 1813. So somewhere at this area, at least that. Should the next peak be at the same level as here, or even lower, that would imply a concentration of the price action, and practically that would also imply the possibility of a sideways movement. We would require higher peaks and higher troughs for the bullish outlook to be maintained. So that should sum it up for the day. From all of us here at IronFX, best wishes for solid trading.
Hello, my name is Christina, and today we will focus on the steps to build a solid trading plan. Usually, one cannot be a successful trader without building a trading plan, as you will be vulnerable to trading mistakes, overtrading, or making rushed decisions. Irrespective of the trading instrument you choose to trade, having a well-structured trading plan in place helps to build a solid trading strategy and a balanced trading system. In order to have an effective trading plan, you need to clarify the steps you will follow once you enter or exit a trade. Now, let's talk about the steps to building a proper trading plan. Firstly, you should determine what drives you or what moves your decisions. Understanding what motivates you trading as well as the time frame you're willing to spend on each step is of high importance while building your plan. Consider the reasons why you want to become a trader and the things you want to achieve while trading. The second step is to set your goals. But remember, your trading goals shouldn't be random. Instead, they should be target able to be measured and achieved, have a deadline and be relevant. It is vital that you set profit goals on a weekly, monthly, and annual basis and reevaluate them frequently. Also, you should define the type of trader that you are. Your plan should be based on your trading personality, risk appetite, and the available time you're willing to spend on trading. For example, we have position traders that hold position for weeks, months, or years, expect to profit in the long term. Then we have swing traders that hold positions for a few days or weeks with the expectation to profit from short to medium-term movements in the market. There are also day traders that hold positions for one trading day so as to reduce costs and risks, and finally scalpers who target multiple small profits by placing several traders for a few seconds or minutes. Going back to the steps you need to follow, another step that is worth mentioning here is the choice of the product or products you want to trade. Keep in mind that the details regarding your trading plan will be determined by the market you choose to trade. Moreover, you should establish your overall capital, as this is the amount of money that you will trade with and can afford to lose. Last but not least, keep a record. This step is usually easier for experienced traders. However, you should always know why and how you made a profit or took a loss, so as improve next time. You can even keep notes with details and comments regarding each trade and the outcome you learned. This way, you always go back and evaluate everything, adjust and reapply. Thank you for watching. Stay tuned.
Okay, all right. So let me begin today's session. Today's session is on top trend indicators. Okay, it's there are a lot of ways to trade trends, right? There are a lot of ways to trade trends out there, and it's one of the most profitable trading strategies. When you're trading trends, there are two things you can do. Let me see. I can pull out my my pen over here. When you're trading trends, there are two things you can do, right? You can, when there's a trend, you can either continue to play the trend, right? Or you can, so this is one way, you're playing the bounces, you're playing the bounce, you're playing the bounces over here. So this is one way that you can trade, to make money. Hey, Natalia, nice to see you tune in. And there's another way of trading trend, which is, when there's a trend, you play the breakout over here, right? So there are essentially two ways to trading the trend. Both are equally profitable, but it's very tricky. Many times we think that we're going to play a breakout, then it comes down, then it comes back up here, right? It comes back up here. So you end up losing money, right? So sometimes, we think that we want to play the bounce, then it end up breaking out, and we end up losing money. So there are many times when this happens, right? And we need to ask ourselves, right? How do we reduce the chances of that happening? Yeah, right. How do we reduce the chances of that happening? How do we reduce the chances we get freaked out here? When we think it's going to bounce, then it breaks out. Or in this case, where I think it's going to break out, then it bounces, right? So how do we avoid that happening, right? So in today's webinar, right, I'll be showing you some of the ways that I've done it myself, right? And to really increase the probability of my trend trades working out nicely. Okay. Now, guys, if you're here, what I'd like to encourage you guys to do is there's a chat panel that's open, where I can see a couple of people sending messages through, right? Feel free to send your messages in there. I go send my message one more time. Hi, right? So send your messages in there. So I literally have another screen open on my left, right? That is monitoring these questions. So if you have questions, just send it through. I'll do my best to get to them, right? Don't wait until the end of the webinar. We might not have time to answer these questions. Anytime you encounter anything in the webinar where you're not sure about, just let me know. I'll do my best to answer them. Okay. And of course, feel free to send any messages in there. Even if you want to chat with me, right? Go ahead, right? Because otherwise you feel like I'm talking to myself, which is very sad. Right? It feels like I'm going to talk to myself, right? So yeah, it'd be nice to see you guys. Hearing a little bit of stuff from you guys. Maybe for starters, if you can let me know which countries are you guys tuning in from, right? Which countries are you guys tuning in from? Because in Singapore now it is 6 p.m. right? It's 6 p.m. here, so I'm just wondering where you guys are tuning in from. Oh, Kurt from UK. So UK is about, what is it, like 9 a.m. there? Oh no, it's about 10 a.m. there now or something, right? Now, I always liked the idea of going to 11 a.m. right? I always thought people who live in UK, they're so lucky. They get to watch the English Premier League. Anytime they want to watch Manchester United, they want to watch Chelsea, Liverpool. They can just the idea that you can watch like the matches there, just so great, man. In Singapore, we hardly have any like football worth watching. Hey, Joshua from Nigeria, good stuff, man. Good stuff. Hope to visit there one day, right? Anyway, guys, I can see a couple more of you guys slowly streaming in. Nice to see you guys here, right? Let's begin today's session now. Remember, disclaimer. Everything in this webinar is educational in nature, so nothing should be construed as investment or trading advice. Please do your own little due diligence before you guys trade. Okay. Oh, someone in Singapore, right? Singapore. I'm not sure if you in your 7 hours stopover, did you manage to check out the Jewel, right? We Singapore has this thing called the Jewel. Is right in the airport. It's a huge place, right? Let me see. A Singapore Jewel. Not Jewel, not jewelry, right? It's actually just Jewel. Yeah, Singapore has this place. It's called Jewel, right? This is literally in the airport, right? You can see like there's the airport around here. It's this massive dome. It's called the Jewel, right? So if you ever stop by in Singapore, do check it out. It's a really awesome place. I think we have the world's largest artificial waterfall over here, right? So yeah, it'd be good if you guys stop over. Let me know, right? We can catch up for a meal or something. Ishmael, nice to see you tune in too. Good stuff, man. Thanks for tuning in nice and early. Let's begin today's session, all right? So anyway, those of you guys who are here for the first time, a quick introduction to myself. My name is Butterfly House. Yeah. All right, so anyway, my name is Desmond. I run the award-winning research firm Everest Fortune Group and also the Forex Army, right? We are finalists for Best FX and Best Equity Research 2019, 2020, 2021. Right, so I run a strong team of prop traders, right? We usually work with the major financial institutions, telling them where the markets are heading. But we have a special partnership with IronFX where we're bringing guys the good stuff, the juicy stuff, the stuff that'll take your trading to the next level, right? So in today's session, it'll be a fun time. I'll be showing you how the pros use the different trend indicators out there as a confirmation. Better ways to improve the probability of playing the bounce or playing the breakout. Okay, now let's begin today's session. Okay, Now, the agenda for today, I'm going to show you, I'm going to talk a little bit about trend indicators, right? We're going to look at the 5 most effective trend indicators. I'll talk about implementing it into a strategy. How do you play the breakouts? How do you play the breakouts and how do you play the bounce? The reversals rather, right? So just so that we're on the same page, breakouts are when prices breaks out of a certain level, right? Bounces is when, you know, price bounces up from here, right? So there are 2 ways to play trends. One is, you know, you go with the trend is your friend. The other is you play the breakout from the trend. Okay, so these are these are important things that we can do. We'll be exploring today, right? So on to the first, or rather, introduction to trend indicators, right? So there are many trend indicators out there, right? All of them kind of one way or another, right? There's stuff like the Ichimoku cloud, we call it IKH. There's some moving average indicators. There's stuff like even the MACD. MACD actually measures once it crosses the signal line in the middle, right? That's where, you know, it's a little bit picking up of momentum, right? There is a stuff like, for example, a moving average crossovers, right? There is the ADX, right? ADX, very useful indicator if you know how to use it correctly. ADX, you can use it. It measures the strength of a trend, but it's usually a little bit slow. It's a little bit it's a little bit slow when it comes to using the ADX in measuring trends. So I'll be showing you one of my handy dandy what's the word for it? Handy dandy indicators, trend indicators I use that have worked out pretty nicely in the past, right? And I still use it up to today. Okay. Now, a few important links that I want to point you guys to before we begin. Right, IronFX.com. You want to go to for the upcoming webinars. You want to go to you just need to wait for the drop down to appear. IronFX School, right? You want to go to webinars, right? So under webinars, this is where you get to see all the upcoming webinars. What you can do is you can click on English, right? They can see, right? These are introduction trend indicators. Tomorrow's a live trading session. Me or Cassandra would be taking it. So go check it out. All right, we got advanced moving average strategies next week. If you want, please go register for it. I'm just going to copy the link here and send it to you guys. Right, go register when you have the chance. Okay, this is advanced moving average strategies. Will be an expansion of what we're doing today. Right, but it's a really great way. I'm going to show you how to use moving average. Pretty fun in a pretty nice manner. Oh, cool! The webinar is live now. Right, so this is the first thing you can go place. The first place you can go to. Second is these past webinars, right? Past webinars, great place for you to catch up, right? This is me, Cassandra. A couple of new people coming in, right? This is where you can watch, like you click on English, you can watch all the previous webinars we did, fundamental, technical, support and resistance, right? Great place for you to learn all the previous stuff we talked about, okay? So go check it out over there. Now, let's begin today's session, okay? Give me a second. Sometimes I talk too much and my throat hurts. All right, so let's go. The first thing is the Ichimoku cloud, right? The Ichimoku cloud is one of the best indicators when it comes to trend. Now, there are 2 kinds of, let me see if I can pull it out over here. There are 2 kinds of, when you use the traditional Ichimoku cloud indicator, right? I'm going to show it to you over here. Usually, when you use an Ichimoku cloud indicator, it comes like this. This is how it looks like, right? And this can be quite overwhelming. If you look at it, right, there is the leading, the Chico span, right? The the leading span, all the different kind of like basically conversion based lagging, leading A, leading B, right? So there are all these kind of different lines, and it can be a little bit overwhelming when you look at the Ichimoku this way. So a lot of people, when they try to use Ichimoku, what they don't like about the Ichimoku is that because of all these lines, it makes the chart over cluttered, right? It makes the chart over cluttered. So what you can do instead, right? What you can do instead is actually you can click on this setting, remove everything, and just leave the background. Leave the background as it is, and this is good enough, right? This is good enough for trading simple trends. Right, you notice how it works very well when price tends to be trending in area. You can see how price tends to respect this area. When it breaks this area, it kind of goes down, right? When it breaks this area, it goes up. It failed to break this area, come down, failed to break this area. So price does respect the Ichimoku in some ways, right? It doesn't work that well if it is like in a ranging market, right? But when it starts to trend, you can see how crossing below, you could catch a very, very nice trend all the way down. Of course, how do you get out at the bottom? How do you get out at the top? This is a topic for another day, right? But you can see that the Ichimoku can be used as the Ichimoku cloud, right? Over here, it can be used as a great way to trade the trend, but you cannot use it by itself, okay? You cannot use it by itself. Ichimoku is weak when the cloud is small. Look at the cloud over here. It's small, it's small, it's small, it's small. It's not that great. It's very thin, right? So if the cloud is too small, it's not that strong. You think about it, when it's raining, right? When it's raining, if you have a huge cloud up there, you got a lot of rain, right? But if you have like small little clouds in the sky, right? It's not that great, right? It might not even rain. So when there's a big cloud over here, that's where you can see price tends to work very well. Even when there are big clouds, now this is a trick, right? There's big clouds on here, big clouds on here. But if price tends to cut right through the two clouds, right? This is actually a trick that sometimes people don't realize, right? They're like, oh, there are big clouds over here, there are big clouds over here, but they don't realize that price can sometimes just cut right through the clouds. Imagine you are, you're Superman over here, you're flying, right? You fly through the clouds, right? When you fly through the clouds, then you don't get wet with whatever clouds are over here, right? So that's a trick when it comes to Ichimoku. Just because there might be a big cloud over here and a big cloud over here, right? If you actually cut through the weak point, right? That's actually a one way to break through the resistance or support, right? One consideration for you guys to take note of. When they get caught in a cloud, it tends, you could see stuff like that where price is fighting and caught within the cloud, right? So the Ichimoku is a great supporting argument, right? The key word here is supporting. It is not a trigger. It is a supporting argument, right? That means it is used to complement your trading analysis. It's never used as a trigger to enter your analysis because the Ichimoku is still a little bit lagging, right? It's not as accurate as some of the other stuff which I'll be showing you in a bit. It's more used as a lagging indicator, right? As a supporting argument, okay? A supporting argument. All right, so yeah, this the first thing I want to show you is Ichimoku. I guess we can scroll back a bit and we can see like how the Ichimoku performs. You notice that in times where it's ranging, right, it really doesn't perform very well, right? You can cross below, cross on top, cross below, cross on top, cross on top. But yeah, once it breaks a key level, right, and that's where it could open a bigger move down. Just looking at Ichimoku cloud will help you trade better, right? Of course, the key thing here is that don't just use it as your main form of trading, okay? Don't just use it as your main form of trading. Let me just see if I can draw an example over here. I do have some examples drawn out, right? I have some examples drawn out. I'll see how I can show it to you in a bit, right? I know we do have some examples here. Very nice channel break. Could be. Never mind, right? I prepared some for us to go through. Right. So anyway, the Ichimoku cloud is one of it. Let me show you the next thing. Right. The next thing is the golden and death cross. Right. The golden and death cross. They are actually called the 200 and 50 SMA crosses. So this is when the 50 moving average here is the goal line, and the 200 moving average is the black line. Right. So when this happens, right, when the 50 crosses below the 200, this is what we call a death cross. So usually when this happens, right, actually is the start of prices kind of going down, right? And when the 50 moving average crosses above the 200 moving average, this is where you call it a golden cross, right? And that usually speaks to the start of a very, very nice uptrend. Now, there are ways for you to get out of a trade before this happens, because most people who trade the golden and death cross, one of the problems is that when you imagine when the cross happens here, you get in here. If you wait for the cross to happen over here, which is over here, look at how much of the trade you have given away, right? You got in over here, right? Which is about over here, right? You end up making this much. Maybe if you're lucky, you make this much money, which is crap, right? It's not that much, right? So there are actually other ways where you can get out of the trade. If you got it, you could actually have caught all the trade all the way down. This would have been your maximum potential. This, you could have made this much instead of this much over here, right? So how do you get out of a trade before, like maximize the most out of a golden and death cross? I'll be showing you guys how to do it in a bit. Okay, now golden and death cross, right? How we can actually look at some of the golden and death crosses here. So I have an indicator that just loads the MA 50-200. You can see it kind of works out well most of the time, right? So there are the downside of this is there are false signals, right? You could have something like this, when you have a death cross, you think it's going down, it goes up, it cuts you out, right? And then it goes down another time. But if the one time you do catch it, right, it goes all the way down very nicely over here, right? You can see go down, go down, go down, go down. It's a nice big move you're catching, right? It's a nice big move you're catching. There are other times where, cross up, by the time you thinking of going up, it starts to cross down over here, So this part is where this is the problem with, this is the kryptonite of the moving average crossover, is that in a rangy market, it will completely, wipe you out. But if you catch it at a good time, like this, you can write a massive move down, right? All the way until it gets out, maybe over here, right? Most of the time, each time you get one massive trade like that, you might get multiple trades where you get wiped out once, wiped out multiple times, right? So this is an important, how do you avoid stuff like that? How do you avoid stuff like that is part of what we'll be covering today, right? It's what I call indicator confluence, right? Using multiple things to really improve the accuracy of your trend lines breakouts. Okay. Next thing I do want to teach you guys, right? I'll be showing you guys right now. On top of the golden and death cross, which uses the 250 moving average, is the price times moving average crossover. So I know it sounds quite simple, right? Price, as you can see over here, crossing over the moving average very nicely. Then it goes on a nice little journey all the way up, all the way up, all the way up, as you can see over here. This doesn't happen all the time, but it happens enough, right? Moving average crossover, you take a trade, it goes all the way up, right? So this is one of the nicer, very simple, and it's oversimplistic, right? So this is where I'm going to show you guys another method, which is called the before this, right? Before the natural moving average, another very, very nice indicator that we use are channels, right? The key thing to focus about channels is that you need 4 touches, right? You need 1 touch, you need 2 touch at the bottom minimally, and you need 2 touches at the top. Or you can consider this another touch, right? So only when you have 1, 2, 3, 4 touches, then it becomes a channel. 5 touches is still a channel, and this is where you can kind of play the bounce, right? So what have we covered so far, right? Now I'm going to show you how it all comes into play later when we combine them together, right? But you can see we have the Ichimoku cloud over here. That's number 1. Golden and death cross number 2, right? Price times moving average cross over 3, right? We got channels number 4. The fifth one, the fifth thing that I wanted to teach you guys is actually the natural moving average. This is actually one of the key parts of what we're going to cover today, right? Because it's a concept which very few people know about, and very few people know about. All right. Now, in this example, which looks better, A or B? Right. This is a moving average from A. This is a moving average from B. Which looks better? Do you guys want to try to just put in your answers a bit? Kurt, I'll answer your question in a bit, right? Does anyone want to take a guess which looks better, A or B, when you're looking at the moving average? I see some people answering privately to the panelists, right? Some people are saying that A looks better, right? A looks better than B, right? Here you got Kurt saying that A looks better. Okay, most people are saying that A looks better, right? Actually, I got a couple of answers coming in saying that A looks better. Okay, so A looks better, right? You think about it, look at it over here. Bounce nicely once, bounce nicely twice, bounce 3 times, 4 times, 5 times. When price breaks this moving average, it goes down, right? This one it catches once, it misses it by a bit, as you can see, misses it by a bit, as you can see. It catches 2, catches 3 times, and it reverses from there, right? In fact, this one catches the reversal slightly better than this one, right? So we can agree that A is better than B. A is better than B, okay? Now, let's take a look over here, right? So this happens to be the 46 SMA, and this is the 50 SMA. That is an interesting thing. This is a 46 moving average, and this is a 50 moving average. Most people, when they trade, they use a 50 moving average without a second thought, right? They're like, all right, I'm going to put a 50 moving average in there, right? And yeah, they use it to trade. They don't realize that all they need to do is to tweak their moving average just by a bit, right? You know, and you're able to get a much better kind of a moving average that catches more of the bounces. More of the bounces and probably gives you a better indication of a breakout, right? So this is what we call the natural moving average. Because if you think about it, no one has ever said that the market obeys a 50 moving average, or a 100 moving average, or a 200 moving average, right? No one ever said that. Those are just numbers that people throw out there, right, for the sake of convenience, right? What's a 50, what's a 100, what's a 200 moving average? No one ever said the market will explicitly obey that moving average, right? So what can happen instead is when you have a moving average like the 50, you try to fine tune it a bit, lower it by 1, lower it by 2, lower it by 3, lower it by 4, right? Until you can find the natural moving average where price most closely is able to catch the bounces, and that will be your natural moving average, right? The natural moving average is always changing. I can show it to you over here, right? Let's see if I can show it to you over here, okay? Indicator, right? We're going to throw a moving average, right? And we are going to maybe tweak this to 100. Okay, look at this. 100 moving average. Price touch it once, go down. Price touch it twice, go down. Touch it 3 times, goes down, until it finally crosses it, goes up, right? So look at the bounce over here. Okay, this is the 100 moving average. What can we do? You know, at this stage over here, maybe you can see that you might have got faked out and crossed down before going up. Okay, let's see if we can tweak this a bit, right? So in this kind of case, right, when price is over here, right, I'll be saying it looks a little bit fishy. 110. Nope. Maybe 120. Nope. 115. Maybe 113. Right. This could be a better indication for your moving average, right? So in this case, you can see how you are able to capture, you know, when you capture the tops over here more accurately, right? More accurately, it prevents you from being as badly wicked out previously than this. Okay. Now I do. You would not have noticed that, you know, it caught the bounces here nicer, and when the crossover happened, you know, it gave you a much better indication of price dropping, right? And if you're really trailing it, you know, you wouldn't get stopped out. You wouldn't get stopped out, right, all the way down. Of course, right? If you look at it here, right? So this is let's take a look here. You know, you realize it nice. is right about there, right about there, right about there. What happens when you do at the 100 moving average? You can see on the 100 moving average, this part over here, right, is not as nice. You know, it actually closes below the 100 moving average, right? And you might have got stopped out unnecessarily, right? So it doesn't capture it that nicely, right? It's all about, so we got people asking like what moving average to use on a daily chart. The trick is to use a moving average that catches price. Use the standard 50, right? You got 100, we got 200, and then you fine tune it from there, right? You need to fine tune it to get the natural moving average, right? Let me show you some additional examples, right? Let me show you some additional examples over here, right? So let's just say, usually a trend. So I'm just trying to pick up the best example. Maybe you do the 200 moving average. Let's go for something like the 200 moving average, okay? Now, let's see, in this case, the 200 moving average, you know, you might have been able to trade it very nicely, right? Seeing how price, you know, reverse from there, reverse from there, reverse from there, right? Reverse from there. You will notice one thing though, when you're using the 200 moving average, I'm going to zoom in here. Look at how many times that price closed above the moving average, right? Close above the moving average, close above the moving average. If you were using a close above the moving average as your indication to get out of a trade, man, you would be in for a tough time, right? You will have closed out the trade here once, close out the trade here twice, close out the trade here 3 times, close out the trade here 4 times, because each time price closed over the moving average before dropping down, correct? So a natural moving average in this case, right? So in this case, if you use it over there, right, you would have, maybe you were saying that, okay, price reverse, right? And then you're trading from here. You think that price is gonna break up from here. You want to go long, but it goes down, right? It goes up again. You think it's going to go long, it goes down again, right? So you end up losing a lot of money when it comes to this moving average. But if you, with this data over here, with this data, if you were able to fine tune it, right? So let's do it like maybe 210. 220, 215. Yeah, 223 over here, right? So you can see how it, you know, it caught the wicks there slightly better, right? I mean, it's still close above over here, right? But it caught the wick here nicer. And then this would have been your profitable trades, right? If you look at this over here, right? Price reverse from there, reverse from there, reverse from there, right? This would have been an even more profitable trade for you, right? All because, right, you fine tune your moving average, right? You fine tune your moving average to go from 200 to 223. I know it sounds a little bit unconventional that your moving average is not 200, not 100, not 50, but this is the trick to it. You know, when it comes to natural moving average, no one ever told you that the market will obey only a 100 or 50 or 200 moving average, right? The market behaves however it wants to. It has its own moving average that it can use, right? It's up to you to find the natural moving average and use it to your advantage, okay? Now, we of course have a question from Kurt. How close does the price action have to be to the channel to be classified as a bounce, right? I think you were looking at this part over here, right? How close does price action have to be to the channel to classify as a bounce? Now, the thing about price action, right, is that I'm going to write the word out here. Price action are like essentially like almost like candlestick patterns, right? Price action only happens in the tick of the action, right? You need things to be going on for it to be considered price action, right? So only when the bar forms, right? Only when the bar forms, then you can consider that, yes, you know, that's where price action has happened, right? How close does the price action have to be the channel to be classified as a bounce, right? Usually, right, it needs to at least touch the, what's the word for it? It needs to at least touch one of the parts of the channel, the lower bound or the upper bound, right? So it is important that it touch the channel, okay, as that is when the key deciding point happens. But always take note that you don't need to be too strict on that rule, because when it comes to channel trading, right, channels are essentially trend lines and they're not that accurate, right? Why are they not that accurate? Is because of this. Let me see if I can show you an example over here. If I had a trend line, See, if I had a trend line from here, right, and from here, all it takes is for my price to move by a bit, and my ending point will be very different, right? So if my ending point is here versus my ending point over here, right, it all looks very, very different, right, based on my ending point. So trend lines, all it takes is just a little bit small movement, and bam, this is now now not a breakout. This is a breakout, right? So when you're trading with trend lines and channels, a channel, right? Like as I said, a channel is just two parallel trend lines, and the problem with channels is that they are a little bit unreliable, right? So where'd they go? Yeah, the problem with channels is that it is a little bit unreliable. All right, so the channels are used more as a gauge. More as a gauge to know that, okay, price is moving up, it's bullish momentum. I'm looking for bullish reversal. Don't use it as the confirmation, right? Don't use it as the confirmation. It rarely ever works well. Okay, I hope that answered your question, Kurt. But if it didn't, let me know. I will try to answer it better. Okay. Now, so there's another thing that I want to show you guys, right? Oh, sorry, right? Beyond the natural moving average is that, yes, if you tweak your moving average by a bit, you might be able to find a much more accurate setup, right? You might be able to find a much more accurate bounce or a breakout that can happen, right? So don't hesitate to tweak your moving average just by down and up a bit and try to catch as many bounces and reversals as possible to improve the accuracy of your moving average. Okay. Now this is an example of having a double confirmation for your channel breakout, right? So usually you have a channel breakout, right? But this time you have a channel breakout and you have a moving average breakout. Okay, so you can see how price over here, it broke out from that level. So if it were to break a channel and if it were to break a moving average, or rather a natural moving average, it goes from a low probability trade to a medium probability trade, right? So you can see how price really broke nicely from here. There we go. And price comes all the way down to here, right? And you can see how the breakout worked out very nice. But this is a double confirmation. It's called a double break. So it did not only break the channel, but it also broke the moving average. So that gives us additional confidence that the break is successful and it should drop very, very nicely. Which it did over here. So one of the tricks to do is, of course, combine your channel breakouts, whether it is channels, whether it is moving averages, whether it is channels, moving averages, trend lines. Those are things that you can, if you combine it, it's okay. So you can see how the drop worked out very nicely from there. All right. So now I do want to show you this concept of confluence. Okay. So this is a chart you can see over here. It's a channel. You got 1 touch, 2 touch, 3 touch, 4 touch. Yeah, correct. Yes, the user channel more as a gauge. Gauge of the trend, it's not just a, it should not be used to confirm your entry. Okay, so your price action does not need to be that close to it, right? 5 touch, right? Yeah, it's doing good. This trend line is great, man, right? I mean, this channel is great. On top of a channel, right? So you're expecting prices to continue going up, right? And then you throw on a natural, I call it the NMA, natural moving average, right? So then we can see, price bounce up quite nicely. So it is a natural moving average. You have a channel, you have a natural moving average. Okay, then you go down here, right? You have Fibonacci confluence. No, I mean you got an Ichimoku cloud, right? Ichimoku cloud showing that, whoa, there is not only a channel, right? There's not only a nice little moving average, natural moving average that's supporting price, but you also have an Ichimoku cloud. So there are 3 reasons why you're bullish over here. Okay, And then you have the last one, which is your golden cross. You know, before this whole thing happened, you had the golden cross, which was a long-term sign that the short-term moving average, has crossed over the long-term moving average. When this happens, right, is what we call a golden cross. That is a sign that price is going to continue rising for a long time. Okay, so we have the momentum of the golden cross, we have the momentum of the channel, we have the momentum of the natural moving average, we have the momentum of the Ichimoku cloud. All of them combined, they give you a much a high chance of price working nicely in your favor. Okay, so you see from here how price, you know, from here we're expecting prices to bounce up, right? We can see how price actually did touch this level. Right, this touched the level and did bounce up nicely as part of the whole concept of confluence. Because guys, you know, when it comes to trading, it's not only about using one thing. You don't just use channel and you trade. You don't just use Ichimoku and you trade. You don't just use moving average crossover, then you trade. You know, you don't just use natural moving average and then you trade. Right, you combine it all together, right, to give yourself the highest chance of getting the trade right. Right, it all comes down to a confluence of reasons, right? Don't trade a single strategy in isolation. Combine multiple of them together to increase your chances of getting a profitable setup. All right, guys. So there's one thing I want to encourage you guys to do. If you're here, right? I know Natalia, right? I've said it before, right? But I think yeah, they are still preparing the landing page and stuff, right? Please go over to vip.ironfx.com, right? This is the link that I'm going to give to you guys. Right, vip.ironfx.com is a place where you can practice your analysis, right? I know we're officially not super duper launched yet, right? It's supposed to be launched within the next week or so, right? So that's why I haven't posted a lot of stuff in there. But when you're in here, right, the nice thing is that you can come in here when you register an account, you're able to actually ask me questions, right? So maybe, right, you are looking at euro dollar. You're looking at euro dollar and you're wondering, hey, you know, has this breakout happened, right? And you know, is this a valid trend line? You can just come in here and say, hey, Desmond, right, is this a valid breakout and also a valid trend line? So what's a valid breakout? Highlight this word, link object to text. You can select the object that you just drew. And what's a valid trend line? You highlight it, select link object to text, select the trend line, click confirm. You can send the message through. So how it looks like when someone reads the message like, hey, Desmond, is this a valid breakout? When they hover the mouse over it, they can see, oh, this was the breakout you were referring to, right? And this was a valid trend line that you're referring to. So I can say, all right, this is lit, right? I'm going to give it a fire, right? I'm going to view discussion. I'm going to have my own separate discussion over here, right, saying that, hey, you know, maybe something like that. It looks like a cup and handle, maybe cup and handle, right? Highlight this, link it to whatever I just drew, cup and handle, send the message, right? This is the cup and handle that you're looking at, right? So it gives you a lot more opportunities to practice your analysis. Okay, so if you have an IronFX account, you will get access to it. You just need to sign up. All right. Now, all right. Let me see. I have covered most of my what we need to cover for today in today's webinar. Do let me know if you have any other things. Right. I am looking for some of you guys who want me to do some analysis. Right. I am looking at this particular movement here. Looks like a change in the trend. Right. This is how I do my analysis. You know, prices bounce up, bounce up, bounce up, bounce up. 1, 2, 3, 4 critical bounces, right? So when you have 4 critical bounces and this happens, you start to have a low-key kind of panic. Same time, you throw on the moving average, Ichimoku. It has crossed below the Ichimoku. One reason, right? 2 reasons why it might drop, right? For on top of that, right? This little swing low support broken, right? Might be dropping further. Another important reason that we might be looking at, right? Then we look at maybe the moving average, right? Nothing much in the moving average, honestly, right? It's not clear at all, right? But we have 3 reasons here, right? We got the trend line breakout, right? We got the Ichimoku breakout, right? And we look like we have like a support level breakout. So it could trigger a move down, maybe even all the way down to here. Okay. Now, guys, thanks for staying throughout this webinar to listen to the concept of using trend indicators, right, to trade better, right? Do remember, it's not about, right? It's not about just trading in isolation. It's not about just using the Ichimoku, using the trend lines, using channels, right? Using natural moving averages, using golden and death crosses. It's about combining them together, right? So example, in my example over here, in my example over here, right, it's a combination, right? It's a combination of not only the moving average, it's a combination of the Ichimoku cloud, right? It's a combination of the, what is this called? A golden cross, right? It's a combination of the channel, right? So we got 1 reason, 2 reason, 3 reason, 4 reason, giving us nice little thumbs up, right? To confirm us that this is a nice trade and that you should maybe risk like 2% on the trade, right? So this, I mean, this is not financial advice, but this is what I mean by that. If you had 3 of the 4, maybe this is 1.5%. If you only had 2 out of the 4, maybe it becomes 1%, right? If you got only 1, right, then you don't trade at all, right? So that's the approach you should take to confirming the different trend indicators, right? Use it in your trading, right? Use it as confluence and confirmation all together, right? So Sonta is asking how to get recordings and other recordings of webinar, right? I'm going to send a link to you, right? Just head over to IronFX.com. Actually, I can go to IronFX YouTube, right? We can go to playlist over here, right? We can watch the webinar series, copy paste this, right? So you guys can go check it out. All the past webinars are there for you to go through. Okay. It has been a great time hanging out with you guys. Thanks for staying, Summer, Saunter, Natalia, Kurt, Ishmael, Gabe, everyone else, right? Thanks for staying throughout this entire webinar. I hope you found it useful in helping you be a better trader when it comes to trend trading, right? To open your perspective to the different momentum indicators out there, different natural moving average, how you can combine multiple things together to give yourself the best chance of being a profitable trader, right? So that's the key thing that I want to you guys to take note of, is that never trade a single indicator in isolation, right? That's why I gave you 5 indicators. Combine them together to give yourself the best odds of being correct. Okay. Thank you very much, guys, right? Stay safe, trade safe, peace out, right? Thank you, Natalia. I'm glad you like it, right? I hope you guys, the rest of you guys also like it, right? Do tune in for tomorrow for our live trading session. Thank you very much, Ismail, right? Kurt, yes, I think we got approved already, right? I need to send it back to you. Good point. Thanks for the reminder. I'll get you access to the VIP room and the candlestick indicator. All right, guys. Thanks very much. Take care. Yeah. Thank you very much, Kurt. VIP room, summer goal, right? Is this thing over here where you can come in and you practice the analysis and you can get our exclusive, like high probability kind of research, right? To be good, that you can use in trading, right? So go check it out. I'm going to send you the link. Go register for a new account over there, right? Summer, go register for a new account over there. And as long as you have an IronFX account, you should be able to get access, right? Just remember, click on this thing called request access and let me know what is, send a screenshot of your account, okay? That's it for me, guys. Stay safe, trade safe, peace out. I'll catch you guys next week. No, I'll catch you guys tomorrow for our live trading session. It might be me, it might be Jane, it might be Cassandra, but I will let you know. Okay, take care, guys. Bye-bye.
Hello everyone, my name is Emily and today we're going to talk about money management. In this video, you will learn what money management is and how to apply it. In its broader sense, money management is a tactic traders follow to preserve their funds. This way, they limit the risk of their portfolio while potentially maximizing its returns. In any case, money management is the aspect of your trading that greatly influences your profits. So it is an important part of a successful trade. In fact, according to studies, almost 90% of the divergence in a trader's performance is because of money management. Although it's not complicated, it requires discipline. Interestingly, irrespective of having a solid trading plan in place, without money management, you could still lose money. However, with a good money management system, you could improve your plan's performance and potentially have great returns as well. The basic elements of money management are the following: a stop-loss order for each trade, a certain amount of funds to risk in each trade, and the maximum amount to risk in a certain period. So the question is, what amount of risk should you take? According to experienced traders, you should never risk more than 1 to 3% of your equity in total in a trade. More aggressive risk could take your account as high as 20%, but there will be larger swings, and this could affect your judgment. It is true that every trader sees risk in a different way. However, the time you have to put in your investments, availability of capital for present or future movements, personality, and risk tolerance are some factors affecting how you see risk. What is important is to keep your risk small and constant, and remember that one trade should not matter. Thank you for watching.